So we're coming to the fourth part of our seminar video series, Deal Structures to Really Get You What You Want. So what we want to talk about is basically the deal structure and the deal asking price. So before I get into that, however, let me talk about 7 mistakes to avoid. Number 1, the business is too dependent on the owner. We run into that scenario quite often. So if you are looking at selling a business, you need to delegate responsibilities. Number 2, lack of valuation and planning. We talked about that before. Number 3, here's the big one, hiring the daughter-in-law to provide legal advice. That is for sure going to kill the deal. You need a specialized attorney familiar with transactions. And that is a very special category within the legal profession as other categories, real estate, closings, divorce, and so on and so forth. Most likely your daughter-in-law doesn't have that expertise, and to bring in an attorney who doesn't have the expertise spells disaster. Number 4 is the insufficient financial reporting. Number 5 is neglecting to manage the business during the deal. Number 6 is to allow buyers to do the due diligence before the deal. That is basically there needs to be an agreement between buyer and seller what the deal looks like before the buyer should engage into the due diligence. Last not least is the attorneys to call all the shots. We talked about that briefly before. Ultimately, we will put a deal into place. The attorneys are to facilitate the legal aspect of the transaction by composing the asset purchase agreement or stock agreement. Now let's talk about the deal structure and the 5 components of a deal structure. First of all, that's what we love most, is the cash down and the bank financing. Bank financing extended to the buyer, who combined with the cash provides the cash equity and the bank financing as a cash portion at the closing deal. Number 2 is the seller note. That's what the seller extends as a credit to the buyer to purchase the business. Typically, it's done over 5 years, 8%. Number 3 is the debt assumption. So if the business has debt that can be transferred, very often like vehicle loans and so on and so forth, that are at fairly favorable terms, then it makes sense for a buyer to assume that debt rather than paying cash for the seller then to pay off that debt. Number 4, contingency payments. Sometimes we run into scenarios where we have earnouts and royalties. That is when we need to bridge a gap in between buyer and seller when they can't agree on a deal. Last not least is Uncle Sam, tax payments. They are taken off the top, and the seller needs to take this into account. Now, specifically looking at these components, is cash down and buyer financing is around 75% of the transaction price. It varies, but that's a very good rule of thumb. Most acquisitions are being executed with SBA financing, meaning the SBA has a first lien on the assets. Sometimes the SBA requires full repayment for the whole still period. The SBA will not agree on partial acquisitions. Typically, the SBA will not extend majority for the loan for longer than the lease that is in place for the business for the respective property. Last not least, the SBA financing is not inexpensive, requiring quite often quite a bit of fees. At points of times for smaller deals, it is advantageous to leave the bank financing completely out, essentially increasing the cash down from the buyer and increasing the seller note. Facilitates the deal typically much faster. In terms of the seller note, it's typically between 10 to 20% of the transaction price. It is a vote of confidence on the seller's part towards the buyer that the business will continue to succeed. Financially, it makes very little sense from a buyer's point of view, because the funds the buyer can raise through the SBA are usually at about 6 to 7% over 25 to 30 years, whereas the seller note is 8 to 9% over 5 years. So the cash flow charge against the operating cash flow under seller note is considerably higher than it is under the SBA bank financing. However, at times some buyers still insist on it. We as a company always advise the seller to offer the seller financing simply to keep the pool of buyers as large as possible. Not doing so will typically lead to about a 20% reduction in the purchase price. The question here is, how is the note collateralized? We are looking at preferably non-business assets. And we want to make sure that the business owner is held secure in case if the buyer defaults on the seller note. But the seller note at the end of the day will be second to SBA lending. Next is the debt assumption. We briefly talked about that. Accounts payable at a typical month's end balance is part of the debt assumption. It's adjusted at closing. It falls under the category of net working capital, basically consisting out of accounts receivable plus inventory minus accounts payable. Sometimes you have other factors coming into place, like cost in excess of sales. Vehicle and equipment loans are a part of the debt assumption. There's positively no debt assumption for shareholder loans, personally guaranteed loans, or bank credit lines. These three categories just cannot be assumed. Contingency payments. We use them at times to bridge a gap between the seller and buyer expectations. It can work well at times. Obviously, a seller likes to see a full cash payment at closing, but that might not always be possible. Gross revenue as a basis for determining these contingencies payments is a better factor than the bottom line. As we all know, net profit can be very widely manipulated, so the gross revenue provides a more secure base and protects you against post-closing litigation. There are upside and downsides for both parties. Often new blood generates new additional revenues, but ultimately who drives the bus? We had as an example is we had a buyer offering $1 million for a business versus a $1.5 million asking price. That was for a psychological testing facility in the pharma industry. It was kind of difficult to bridge the gap, so ultimately buyer and seller agreed on a royalty, establishing $100,000 for 5 years as a payout and applied that as a percentage to revenue. It ultimately worked very well because the seller came out ahead of the equation. Last but not least is Uncle Sam. Most transactions are being done as an asset sale versus a stock sale. That means that the buyer sets up a new corporate entity, whether it's an LLC, subchapter S, or a corporation, and he funds that particular entity, and then this entity buys the assets, liabilities, name, goodwill out of the seller's entity and transfers it. That generates different tax liabilities because not only will the assets, the depreciated assets, being recaptured in terms of income to the seller, but also when the funds are in the corporation of the seller, then they need to be dispersed to the seller, and that can imply a certain extraordinary dividend taxation. The problem is most significant with C Corps, whereas S Corps and LLCs are typically lesser tax because there's a flow-through effect. Most of the buyers will insist on an asset sale. The attorney of the buyer will always insist on an asset sale. There is another effect that comes into place here is besides the limited liability exposure to the buyer under an asset sale scenario, there's also the fact that the buyer builds depreciation shield for future cash flows. What that means is, in an asset sale, the assets are being transferred out of the old entity into the new entity and can then be depreciated in the new entity according to the respective depreciation schedule. So a truck that might have been written off completely before is basically transferred at market value and can then be written off a second time. This provides a cash flow tax shield for the buyer and makes an acquisition much more cash flow rich than not having this option. So between the liability exposure and the tax shelter, buyers always tend to do asset sales. In some scenarios, that is not possible. For instance, if there are vendor qualifications, I mentioned earlier on that example out of the pharma industry, whereas the company that was to be sold had established vendor relationships with Fortune 500 pharma companies, and that's very difficult to obtain. So if you have a strong vendor relationships, strong licenses in place, then a stock sale might be the only option. The bottom line really is, at the end of the day, you need to consult a qualified tax planner and M&A attorney well before a transaction in order to be in the best position. Thank you very much. This concludes the fourth part of our video presentation. We appreciate your time. We are certainly looking forward to answer any questions you might have. It's a very complex topic, and we have the experts in the field to help you in the early stages of preparing a business for sale. Thank you very much.